everyone, Shane Tenny, Managing Partner at Spaugh Dameron Tenny, coming to you with 4 tax tips for wealthy families as we end the year. You want to pay attention because tax tips don't do a lot of good in the spring when you're filing your taxes. Now is the time to pay attention and take action. So what are they? Well, number 4, take advantage of your tax-deferred retirement plans through work. The limits that you can contribute to your 401k, your 403b, or a SEP IRA go up each and every year. If you didn't make an adjustment earlier in this year to max out, you may not reach the limit and will have given up the opportunity to defer more taxable income. So check your latest pay stub, do the math, make sure you're on track to max out your 401k at $23,000 for this year, or if you're eligible to contribute to a SEP IRA because of side income, moonlighting, work, something like that, the limit this year is $69,000. Number 2, don't forget to look at your investment portfolio for any potential losses. Now, I realize the stock market has been on a nice run the last couple of years, but if you have a mutual fund or a stock that is worth less than you originally invested, that temporary loss, if you sell it, can be used to offset the tax liability of any gains in investments. And if the loss is large enough, you can even use up to $3,000 of it to offset taxation on ordinary income for this year. Number 3, charitable donations. There's a couple ways this can help out. Number 1, if you have appreciated investments, stocks or mutual funds that have gone up in value, instead of paying tax on that profit by selling the investment, you can give that away to a charity and avoid capital gains tax on the unrealized gain and get a deduction for the gift. Just reach out to the charity or the organization that's important to you and ask them how they can receive appreciated investments. The second way this can help is by giving away cash. Making donations to organizations or rescue relief or those sorts of things are deductible to reduce your taxable income. If you're writing a check, you want to make sure it's postmarked by December 31st in order to get credit for this year. And the final way that many of us can make charitable donations is by cleaning out our garages and our closets. That furniture, those household goods, the exercise equipment, or the clothing that you no longer use is worth something to someone else. When you make donations to organizations like Goodwill or the National Kidney Foundation, you'll receive a tax receipt that will allow you to deduct the value of that on your tax return if you itemize. And number 4, defer income or accelerate expenses. If you have the ability to control the timing or the receipt of, say, a year-end bonus, if you receive that money in January, it generally isn't going to be taxed to you in 2024. And likewise, if you own a business and have expenses that you would ordinarily plan to pay in January or February, say buying new furniture or equipment, maybe paying property taxes. If you pay those things in December, you'll be able to use the deduction against your taxable income for this year. So there's our 4 tax tips. Hope it's helpful. As always, if you have any questions, don't hesitate to reach out. We're here to help.